going to try and do this evening is I'm going to try and give you a really broad overview of the investing world. Okay, we're going to cover a lot of different topics. Just a few ground rules before I even start. In terms of questions, so if you have any specific questions during the course of the evening, so just put them in the chat. Ariel Gold, who's also on this call with me, is one of our portfolio managers, and he's going to be manning the chat. And we'll stop every 15 minutes or so and go over questions, and he'll read out the questions, and we'll try to answer as best as we can if there are specific questions. Okay, I'm gonna tell you, just go over a little bit. I'll tell you this is a background in terms of my company. So we've been in the business now for a couple of decades, helping mostly, I would say, Olim, who are here in Israel, who are coming and needing to integrate their finances from their former country of origin, whether it's US or European countries, Canada, South Africa, Australia, right? Integrating that into the Israeli financial system, right? So I came on Aliyah in 1993 from Toronto. I'm originally from Winnipeg. And I'm licensed here in Israel as a portfolio manager. We'll talk about a little bit about what that is exactly. And our company helps people with asset management on the one hand, and in general, we do a lot of financial consulting and planning as well, and helping people to find some alternative investments too. I've been lucky enough to travel with Nefesh B'Nefesh also now for a couple decades. Attending events overseas, and if anybody on the call is in the New York area, so we will be at the New York event or the New Jersey event in about 10 days, 12 days, something like that, at the beginning of March. So you can catch us there as well. Okay, we're going to go through the basics of investing. Why do we even need to be thinking about investing? Why do I need to invest? And why is it so important? It's interesting. Usually the session that I give tends to be the last of the sessions that are given about finance, because people generally have budgeting and pension questions, mortgage questions, all these other things, and then they come to investing, right? I actually happen to like the fact that we're doing investing first, because now when you approach all the other topics, you're going to understand where investing fits into everything else. And you're going to see how it impacts on all other areas of your finances. Okay, so we're going to go through the investing basics. We're going to talk a little bit about the Israeli capital markets, what the differences are between investing here in Israel versus abroad, some of the taxation issues you need to be thinking about when you're investing in Israel. We're going to go through partially like a due diligence checklist of things that you need to be thinking about when you're investing. And we're going to talk about just what are some of the major differences between doing it yourself versus doing it through a professional. Okay, that's our basic agenda. Okay, let's talk a little bit about why you need to have information about investing. Okay, investing impacts on our lives in so many different ways. You might think, oh, what do I invest in? I don't have an investment portfolio, so what do I need to learn about investing? But it's not really the truth. It's not the case, because we all are investors. Right? In Israel, for instance, I'll give you an example, that we have 20% or more of our salaries being put away for us by our employer and invested in retirement accounts. And so we are going to have a lot of money invested for us, and we need to know how to invest that money. Okay? And if you get started in the right way, so you can make a tremendous difference. It can make a major difference between how you decide to invest that money if you just get educated at the beginning and make the right choices, right? If we have any children, so Israel funds, it's called a chisachon l'chol yeled, which is a savings account for every child that's born until 18. So everybody's also investing for their children, right? So there's lots of different ways that we are investing. And we need to be aware of what our choices are and how it can impact. Okay, so let's go over an example here about the power of investing, the power of compounding. It's often been called like the seventh wonder of the world, because the impact of compounding over long periods of time is really, really tremendous. Okay, I'm going to show you a couple of charts right now, a couple different examples so that you can understand what this power is. Okay, this chart shows an example if you would take $10,000, again, it doesn't matter, dollars, shekels, and you invest that money over a long period of time. So you see on the left-hand side, we have the year, 5, 10, 15, 20, going all the way to 35 years. We're not adding any additional money. We're just taking that $10,000 and we're investing it for that period of time. And then across the top is the rate of return that we are earning on our money over that period of time. Okay, so let's take the ultra conservative, and I would say even somewhat of an ignorant investor who puts the money in a short-term savings account in the bank and maybe makes 2% a year over that period of time. So you can see that that money will grow from 10,000. If they do this for 35 years, it'll get to almost double, to almost $20,000. Okay, you might say to yourself, okay, my money's doubled over 35 years. Well, so you have to think that what's the impact of inflation over that period of time, right? Inflation might be running at 3 or 3.5%, right? Here in Israel right now, inflation is running at about 3.5%. Okay, in the United States, it's very similar as well. So you're not even keeping up with inflation. So yes, you might have double the money after 35 years, but it's actually going to be worth even less than the 10,000 that you invested. Okay, let's go over to the next column, to 4%. What if you were a little bit more sophisticated and you actually locked up your money in the bank for a little bit longer, or you bought maybe a short-term government bond, or you did something where you're going to be earning 4%. So all of a sudden now that 10,000, right, after 20 years, let's say it'll have grown to more than twice as much money over that 20 years. Instead of 35, it'll be 22,000. And if I wait all the way the whole 35 years, so we can see that you almost will have quadrupled your money. I've only earned another 2% a year, but I went from having double my money from 20,000 to having 4 times my money, right? So I now have 40,000. I start off with 10, right? It's 4 times my money. But if I'm a little bit more, let's call it a little bit more adventurous, I'm willing to take a little bit more risk, maybe I'll actually be able to put together a portfolio that will get me 8% a year. So look what 8% can do for you. After only 10 years, my money has actually more than doubled, right? You can calculate how fast your money is going to double by thinking of the rule of 72s. If you take any number and you divide it into 72, so let's say our example here, 10 years. If you take 10 years and you divide it into 72, that means that if you're earning 7.2%, your money will double in 10 years. Okay. Now, the other way to think about it is if you're earning 10% a year, your money will double in 7.2 years. It's a mathematical constant, but it can give you an idea of how long it'll take for your money to double. So in this example, at 8%, my money doubles in just under 10 years. Okay. But if I actually had that 8% over a long period of time, look at the difference. All of a sudden now I'm 15 times my money. I'm almost up to $150,000 in this example. Now it's from the same $10,000 that I invested. And if I could actually get over a 10% or a 12% rate of return, which we're going to talk about ways that you could potentially get that. Oh, that's not something that I would really tell you that you should expect over a long period of time, earning 12%, right? The S&P 500 index in the United States has produced that rate of return over the last 10 or 15 years, but that's a little bit higher than what is like the norm But if you really could get that much money, that much interest, that much earnings on a yearly basis for that long a period of time, look at what happened to that $10,000. All of a sudden now it's more than $500,000. And that is the power of compounding. Okay. Let's take it another example. Okay. If you don't, it's too big a number and you don't want to think of it, it's like too hard to conceptualize. So take a look at this example. What would happen if you took $1,000 for every child or grandchild that you had and you put it away for them and you had it compounding at these different rates of return? You see on the top, we got the 2, 3, 6, 8, 10, and then we see what that money would actually be worth to that child at retirement, at the different rates of return. All right, so look at it. If you're at 6%, if you took that money for your child, that $1,000, and you invested it for them at 6%, by the time they got to 65, they would have $47,000. It would have grown from 1 to 47. But if I could actually earn 10% compounding, so at retirement at 65, 64.8 years, I'll actually have $500,000 from that $1,000. Right? Have you ever thought about creating perpetual wealth? So this is a simple plan to create perpetual wealth for your family. If you put away money when they're very young and you invest it, and even if you invest it even aggressively over a long period of time and they don't touch it, that's the key. They can't go into it when they're 18 and they're taking their trip around the world, or when they want to buy their first car or others. They have to keep it long-term invested. But you see what the impact is at 10%. At retirement, it's going to be $500,000. And if they actually were able to earn at 12%, so you see at 60, they actually would have over $1 million from that initial 1,000. And of course, we're more than welcome to save much more money over time, to grow our savings for our children, right? Much more than this. Okay, and I'll give you a third quick example. Okay, this one actually was like my former business partner shared this with me many years ago. Okay, it gives you an example of what's the easiest way to become a millionaire. So we have two different types of investors. Investor A on the left-hand side. So they start their plan at age 19. Okay, what they did was they saved up, and they save up every year for 8 years, $2,000 a year. And they invest it, okay, until retirement. So all they've done is they've gone on a financial diet for 8 years. They've saved during those critical years. They've saved a total of $16,000. And they invested it at 10% rate of return average until they hit 65, until they hit retirement. So they will have $1 million at retirement from that initial $16,000 investment. So that's investor A. Investor B, however, starts only 5 years later. They go to school first. They decide they're going to go on that trip around the world or do whatever they want to do. And they only start saving when they're 24, which, by the way, is not even really so old. Right? There are many people who don't start until much later. But they started at 24, and then they saved for the next 41 years that same $2,000. Okay, and then that grew over that period of time to $1 million, also compounding at 10%. Both investors have created $1 million. One of them took 8 years and was on a financial diet from 19 to 27 for 8 years. The second had to stay on a financial diet for 41 years, for the rest of their life, basically, until they retired. Okay, that's the difference that compounding and starting early can have on your long-term financial health. Okay, so you think about all these examples are just showing you the power of starting early and giving yourself enough time for your money to grow. Okay, and it also shows you another very important point, which is that if you can get, over the long run, a little bit better rate of return, the impact on your long-term savings can be dramatic. Okay, that difference between 6 versus 8 versus 10% rates of return is tremendous over the long period of time. And why do people choose to invest in the most conservative investment out there? Why do they go for the 2 or the 4% rates of return? So I think it's because of a lack of education. It's because they simply don't, they simply do not know how to invest, what's the right way to find investments, and how to do the proper due diligence, and how to even accept the right amount of risk for themselves. Right? You have to know what type of risk you can take at different times in your life with different types of savings. And we're going to talk about that as we go through the evening. Okay, so all this, when I mention some terminology in English, I'm going to try to also mention the Hebrew, so you'll get a little bit of an opan out of this as well. Right, so this power of compounding in Hebrew is ribit deribit, because that's what it is. Compounding is interest on interest. You're earning interest in year one, and then the interest now becomes part of that principal, and you now in year two earn interest on the interest in addition to the original principal. And then in year three, etc., it grows and grows and grows until it has a tremendous impact in the long run. Now, everything I've mentioned up till now is excluding, right, taxes and inflation. Right? I mentioned inflation, why it's so important to try to get more than that 2 or 3%, because otherwise you're not even keeping up with inflation. Right? We also have to take into account taxation, because for many different types of investments, we're going to be taxed. And so the investments that are available that are actually tax-free or tax-deferred, so those should have a special place in our heart, because they can save us a tremendous amount of money and make the returns be so much more profitable for you. Right? Think about it. If you're making 10%, but the Israeli government or the US government is taking 25% of that, so you're making 10, but you're really only making 7.5% compounded. And you saw the examples of what the difference is between that 8 and 10%. So obviously 7.5 to 10% is even more than that. Okay. Okay. The way I like to think in general about investing, and it's a very simplified way, just so that you can understand that the investment world is divided, what I call, between these three main categories. One of them is real estate, the second is financial assets, and the third is alternative. Okay, let's start first with financial assets. Okay, financial assets include any investments, right, in the market, whether it's a stock or a bond or investment in a fund, an exchange traded fund, a mutual fund. It includes your investments in your pension funds, which are also generally invested in the market in financial assets. Financial assets are generally, although they're not exclusively, but they're generally traded on exchanges. So in Israel, for instance, we have the Tel Aviv Stock Exchange, where all of the local bonds and stocks are traded. Okay. And you have stocks and you have bonds, right? Or as the two main asset classes. Stocks are otherwise referred to as equity, and they are ownership in specific companies. So you can have a company that trades on the stock exchange, which means that they raised money from the public, and their ownership shares are now traded on the stock market. And it can go up and down in value depending on many different factors. A bond is an IOU. It's where a company or a government is raising money from the public. And they also have bonds that are traded on the stock exchange, although they're not all traded on the stock exchange. But many of the ones that investors have access to are traded over the stock exchange. And it means that you as an investor are giving a loan to the company or to the government, and they are going to be paying you interest over the lifetime of the bond. lifetimes of the bond, the duration of the bonds can last for years to decades. Israel even, believe it or not, I forget it was last year or the year before that, they issued a 100-year bond that was oversubscribed in the market. That means that there were investors out there who were willing to give the state of Israel money with the promise that they were going to get their money back only in 100 years. How's that for a vote of confidence, right? You don't hear that all the time in the media, but the financial market has a very high degree of confidence in the Israeli economy and the Israeli monetary system, and they are willing to give them loans for that long a period of time. It's unbelievable. Okay, real estate. Real estate, we're going to talk a little bit less about this evening, but real estate is also an asset class. The average Israeli actually does a lot of investing in real estate, or at least they think about investing in real estate. It's one of the first things that they think of. Most Israelis would invest generally in residential real estate by buying an extra apartment. There's also commercial, there's also industrial, but those tend to be a little bit more difficult to get into here in Israel. The average Israeli is going to get into real estate by buying an apartment. Okay, we'll talk a little bit more about the differences in terms of performance between real estate and the financial world here. Okay, and then the alternative is what I would put in the third bucket is really like everything else besides traditional financial assets and real estate. And that can be, hedge funds and private equity and cryptocurrency, and it could be a whole wide range. And there's all kinds of, private types of investments where people are doing things that you wouldn't even understand, or most people would have a difficult time understanding. So I'm kind of jumping the gun a little bit, but if I was to kind of tell you anything about the alternative space, beyond the fact that only accredited investors can oftentimes access those types of alternative investments. Accredited investors have to have either a certain amount of assets or a certain amount of income in order to be able to qualify to actually even have access to those types of investments. But if you are investing in that space, it's something that you really need to educate yourself about to really understand what types of investments are there, because they're really not for the average person. Okay, and we're going to talk a little bit more later about diversification. I'll mention one quick word, which is just one of the main principles in investing is diversification, meaning not putting everything in one basket, not putting all of your money in one place. Right? If you invest in a pension fund or a mutual fund, so you'll have a manager and they will be putting your money in different types of stocks and bonds, different types of securities. That's one type of diversification, but there are many, many different ways of diversifying your money. You can have your money invested in different asset classes. Gold, silver, precious metals, like I mentioned, cryptocurrency, financial assets, real estate, different geographical areas. You can have your money invested here in Israel. You can have it invested in other countries in different currencies. You can have different lengths of your investments in terms of their term. There are many, many different ways of diversifying, right? So it's like the rule that they use with real estate investing. I'm sure everybody has heard, right? The three most important things about real estate investing is location, location, location. So in the financial world, diversification, diversification, diversification. Those are the three most important rules for investing, right? You don't want to have all of your assets in one investment and then happen to be in exactly the wrong investment, right? Unfortunately, I've heard too many stories over the years of people coming to me and saying that, wow, I thought this was a home run, and therefore I just put all of my available savings into this one investment, and they lost everything. Okay, I'm sure if you look back at major fraud examples like the Madoffs of the world, there are too many of those people in those investments who put all of their investment money, all of their savings into a single investment, a single manager, a single asset class, right? You don't want to do that. You want to diversify into different assets. Okay, let's talk a little bit about, besides the Tel Aviv Stock Exchange, what are some of the other types of savings plans available here in Israel? Okay, you'll notice on this list that there are no pension funds, right? Kupat Gemmels are a type of pension instrument as well, but there aren't any pension funds listed here. Why? Because you have another session completely on pension funds. So I'm not going to really touch on that. But the thing to come away with from the basics of investing with regards to pensions is that how you invest your money in pensions over the long run can make a tremendous difference in terms of how much you have in retirement. Because if you invest in the most conservative maslul, maslul in Hebrew, in English is the investment path or designation. There are different risk levels that you can go into, different funds that the different companies offer, and they offer different levels of exposure to stocks and bonds. Okay, if you invest in a more aggressive pension fund that is able to give you a higher rate of return in the long run, so it can make a tremendous difference. Again, I'm going to keep saying it all night long. That differential is tremendous. If you go into a bond fund in your pension fund, or the most conservative thing, just some kind of like, a government bond, or deposits, and earn 3 or 4% versus if you went into a stock fund, the difference between a 3 or 4% versus a 10% average rate of return is tremendous. So you can't let anyone else decide for you how you're going to invest your retirement income. And there's a tremendous amount of money in that retirement savings plan. Because as I mentioned, and you'll go into the details in future sessions, there's over 20% of your salary goes into these retirement accounts. Okay, now in addition to that over 20%, so there's also a savings plan here in Israel that's called the Keren Hishtalmut. Keren Hishtalmut is like an advanced savings plan. It's probably offered to, I don't know the exact percentage of Israeli workers, but the majority of Israeli employees probably have a Keren Hishtalmut. Definitely all of the high tech and government, all the professional, professions all pretty much have Keren Hishtalmuts. Keren Hishtalmuts are available both for self-employed as well as employees. Employees, the standard is that if the employer contributes 7.5% of your salary, and you as an employee contribute 2.5%. So it's 10% of your total salary that goes into this savings account. And the way it's structured is that these accounts are minimum 6 years of investing. That means you have to contribute to them for 6 years, and then they become nazil or liquid after 6 years. That doesn't mean that you have to take out your money after 6 years, right? Remember, go back to the example I gave you. If you don't have to touch your money, don't touch it. If it can grow for you, especially in a Keren Hishtalmut, which is the best savings plan available in this country, right? Because it's tax-free on the way in. That means it comes from pre-tax money, right? You don't have to pay taxes on your contribution, and the money that you get from your employer is also tax-free to you. It can grow over its lifetime, over the 6 years, or however long your money is invested, can continue to grow tax-free. So when you take it out, you're not going to be paying any taxes in Israel. Depending on your country of origin, specifically in the United States, there may be circumstances where you have to pay taxes there. But my experience has been that under almost all circumstances, you won't pay taxes in the United States either, because the tax rate here in Israel on other assets are higher. On your salary, it's higher. So it ends up being that even if you do have additional income, Keren Hishtalmut, that you take out at a certain point in time, and that's taxable there, you'll have paid more than enough taxes here in Israel that will cancel out anything that you need to pay to the United States. Okay, so a Keren Ishtalmut is really the best savings plan, and it's been around for decades. They keep threatening every year to eliminate the benefit, that they haven't. And I might add that even when we had the tightest budget this past year, budget that they just passed, where they made a lot of different changes, and they were looking for all these different sources of revenue to try and finance the war. They talked about the Keren Ishtalmut, like they do all the time whenever they're looking for more money, eliminating it, but they didn't. And if they didn't eliminate it this year, so I find it very hard to believe that they're going to eliminate it anytime in the future. So, or at least for the foreseeable future. So if you can get a Keren Ishtalmut from your employer, you should definitely be considering it and asking for it. It's very, very valuable. And it's the first place beyond your pension, which is mandatory. It's the first place that you should be saving money. Okay, Kupat Gemels are another retirement savings plan where under certain circumstances, it might also be worthwhile contributing additional amounts there, even beyond your pension savings. Okay, and there are tax advantages to those, including like, having your profits deferred and some flexibility to move between different investment tracks. Americans need to beware. Kupat Gemels are considered to be problematic for US tax purposes, and we'll talk about why a little bit later. Okay, the third one that's listed here is the child savings plans, right? The Chisachon L'Chol Yeled. So the government gives a certain amount every month. I don't even remember how much it is exactly. Ariel, probably you remember more than I do.
55 now.
Pardon me?
55 shekels.
55 shekels a month. And you can actually match it as well. So it can end up being 110 shekels that is being put away on a monthly basis. And they continue to do this until your child hits 18. At 18, there's a bonus of another 500 shekels, I think or maybe it's gone up a little bit, but that's what it used to be. And then if they keep it in another 3 years, if they've come to this class and they don't touch it at their 18th birthday, and they keep it until at least 21, then they'll get another 500 shekel bonus at that point in time. And it can continue to grow and be tax deferred. I think it's even tax free when they take it out, although maybe the gains, I'm not sure. No, Ariel,
there will be 25% taxes on the gains, inflation adjusted.
after 18 or after 21? Anytime. So the whole thing is going to be taxable at some point in time. Okay, but it is inflation linked. That means that you only are going to be paying taxes in Israel above the inflation rate on the real rate of return. So if your savings plan made 6%, but the average inflation rate over that period of time was 3%, so then you're only going to be paying tax on that additional 3%. Okay, things to consider when you're investing in these types of plans. One is the cost. You should always be looking at what the costs are and how much is my management fees that I'm paying, right? On some of the pension funds that you'll be talking about in the future, right? That's very critical, is to understand exactly how much you're paying in management fees, because they often take management fees from different places. Okay, you also want to make sure that you understand if insurance is built into your savings plans. So on many of the retirement savings plans that you're going to learn about, there is insurance that's built into it and it's costing you something. So you have to understand that consideration, right? You have to understand the tax implication like we spoke about, right? How much you're going to be paying tax, or if you're going to be paying tax, and you want to obviously prefer the instrument where you're not going to be paying tax. And then, of course, you have to make sure you understand what your risk profile is, which investment track you're going into, the Maslul Hashka'a, because that will make a major difference. Okay, and if you want to check out actual returns for all these different types of savings plans, so you can go to the government website. There's a site that's called Gemelnet, and they have statistics on Kupat Gemels and on Keren Ishtalmut. There's another website that's called PensiaNet, and they have the statistics on Keren Pensias, on different pension funds, Bituach Nalim policies. Okay, let me take a quick break, and Ariel, you want to go over some of the questions?
Sure. We have a question about crypto. Is it considered a financial asset?
I believe that it would be considered. It's kind of, it's got its own kind of class, but yes, it is traded in a sense. And there are ETFs, exchange traded funds right now that you can access that are purely financial instruments to be able to get access to cryptocurrencies. But I would call it probably something that's like, in between.
Okay, someone is asking if they can choose the risk level of the government plan, which I assume they mean the Chisachon Makol, the kids savings plan.
Yes, all the investment companies offer basically 5 different risk profiles, from a high degree of stock exposure, a medium degree, and a low. And then they have a Hilchati, and they have a Sharia, Islamic halacha-based maslul. And then you can also choose to go into a bank savings plan and not to choose to invest it in the market. Bank savings plans will generally give you a lower rate of return, but they also have lower risk. So some people have chosen those. It used to be that the default was the bank savings plan if you did not choose to one of the other risk profiles.
Someone is asking if putting 100% of their pension, Ishtalmut, Kupat Gemel, into S&P 500 is considered diversification.
It's one type of diversification, but there are many different other ways of also diversifying your money. If you want to read an article about the S&P 500 and why all the Israeli pension funds have been marketing to unsuspecting investors here in Israel the S&P 500 investment path. So take a look at my website. I wrote an article about it 2 months ago that you can check out there, that talks all about the S&P investing.
Okay. The next question is, just lost it. Okay. The investing for Americans in Kupat Gemel. So we mentioned it a little, and we'll mention more later on, right?
Yeah. So we're not. Well, I'll mention it a little bit later on, but it's a subject of dispute. That's the short answer. You're going to need to talk to your accountant and get clarity from them whether or not they consider it to be. It's generally a very small amount of money, so the decision isn't such a major decision. But I would advise people to speak with their accountant about how it's classified.
Okay. What happens to your Keren Ishtalmut when you go on Chalat? Just basically stops and freezes. And
Yeah, the money obviously stays there for you and continues to be invested, but just you're not contributing to it at that point in time.
okay, subtitles in Hebrew. I'm not sure if that's how to do that in Zoom. Okay. The child savings plan is until when they can take it out? From 20 years old and made Aliyah at 15. Should I have some in this plan? I'm not sure what this question is. Anyone under 18 gets this automatically. So if you made Aliyah when you're 15, then you would get that until you're 18, and then a bonus at 21 if you keep it in there. What is the average management fees? So I assume this is referring to current ishtalmut and pension. There's no management fees for the kids savings plan until age 21.
Yeah, so Kupat Gimels and Karen Ishtalmut, the management fees can range. They've come down tremendously over the years. I would say they're in the range of like 0.7, 0.8% is probably like the mean. You have some that are more expensive than that, and depending on, the specific benefits that you have and who you invest through, you can potentially even get it a little bit lower. And depending on how much money you have invested as well, you can negotiate better fees too.
Mhm. Okay, the child savings plan, can you keep it past 21? Yes, you can, and it's better if you can keep it there past 21.
That's our example of keeping it all the way to retirement. Try to convince your kids. If they don't touch it, it can grow tremendously.
Okay. What would be a good high yield savings plan for an emergency fund?
Wait, hold off on that question. We'll talk about the financial assets later.
Okay. Is GimelNet also in English? I don't
Nope.
so. No. Okay, investing in a Karen Kaspit. So assume that's also going to be one of the
Yeah, we'll talk about that a little bit
it's a
later.
money market fund. What would be your recommendation for a child savings plan?
In terms of which maslul, in terms of like which risk profile. In general, if you're able to, you're willing to accept the risk, the higher risk level, I am very supportive of going into the highest risk level, the most exposure to stocks. You have to remember, right? It's a long-term investment. They're not, going to be taking it out when they're 2, 3, or 4. It's going to be invested, and a small amount of money is actually going to be invested. It's called dollar cost averaging. Okay, dollar cost averaging means that you are going in every month into the market. You're buying in, and in this case with the child savings plan, but it's the same thing with the Keren Ishtalmut and the same thing with your pension. We have a major advantage is that we are going in every month. Money is being deposited every month into your account. So even if the market would go down tremendously, let's say would be a crash. So we have the advantage then that we're actually buying at the bottom of the market. We're going in every month. And that means that when we're dollar cost averaging, it reduces the overall risk. And so when you're in a child savings plan and you know you're going to be invested for at least 20 years, I think that the best thing to do is to be as aggressive as you can and maybe if they need the money or you know that your child is going to be taking it out when they're 18 or 20, so then you might want to reduce the risk level, and you can move between different investment profiles. You might want to reduce it as they're getting closer to that age. But no, it's in general, I'm very supportive of being as aggressive as possible with this type of savings.
How do we find out where the child savings plans are invested? So you could log on to the Bituach Leumi website under the Chisachon Kol Yeled. We also have it in English, and you can find out all the information there, and also switch the investment tracks over there. Okay, if you're not sure how to invest, do you recommend getting a financial advisor?
We'll talk about that later too.
Okay. Do I need to pay taxes to Israel state if I have income from foreign financial assets?
We'll talk about that a little bit too. Okay, I think, is there any other critical ones? Well, I think we're going to go on and you'll kind of try to summarize some of if there are other ones that are outstanding that I didn't get to. Okay. Okay, let's talk a little bit about. Okay, here we go. Let's talk a little bit about asset management in Israel. Okay, so Israel, as I mentioned, has one stock market, which is the Tel Aviv Stock Exchange, or sometimes referred to as TASE, right? Not all Israeli companies are traded there, but the majority, I would say, of Israeli companies that are publicly traded are traded on the Tel Aviv market. There are other Israeli companies that are traded on other indexes around the world, like NASDAQ, for instance, right? There's a huge presence of Israeli startup technology companies that are traded over there. Okay, the returns in the long run, and we'll go into some of this a little later also, are very comparable to other Western markets. And in fact, Israel has done better than a lot of Western markets over long periods of time. Okay, we mentioned the real estate, and then there are things like high tech, biotech, startups. We talked about that also in terms of our alternative space. Okay, now in Israel, there are two main places to hold your investment portfolios. One is through the banks, and the other is through your investment houses. So there are investment houses in this country which you can open up an account with and have your money held over there. The most popular way, however, is through your bank account, through a regular bank account. So the bank accounts are structured in such a way that they're usually set up in advance. If not, they can easily be structured so that within your regular account, you'll be able to also hold and buy, sell securities. Okay, the banks and the investment houses in this capacity are acting as the custodian of your assets. Okay, in Israel, there are two financial designations for investment professionals. There is a higher level license, which is called a menahel tik, and those are portfolio managers. Okay, full disclosure, right? Ariel and I are both portfolio managers, so we manage money for clients here in Israel. Okay, there's a lower level license. We manage money here in Israel, and we also manage money in the United States as well through an affiliate company there. The lower level license in Israel, they are called Yoatzei Hashkaot or Mishavkei Hashkaot, and you can choose of the lower level license which one of them to be involved in. Okay, Yoatzim are giving advice. They cannot manage your money, and therefore, if you would work with a Yoetz, and so for instance, the banks have Yoatzim that work for them. The banks cannot hire and cannot have menalei tikim that are being hired by the banks, because as part of the deregulation of the industry going back 20 years, they took away the ability for the banks to manage portfolios directly, and instead they can only give advice. So you have yoatzim who work at the bank and can give you advice. And so you can go into your bank, or sometimes it's concentrated in one branch, and they give services over online, right, to people all over the country, and they're basically giving advice. Okay, it's not 100% objective advice, and they will admit that as well, because they are actually getting paid a fee for marketing certain investments to you. But it's your choice, and you have to make all the decisions with regards to what to invest in. Yes, they might come up with a whole proposal, and they might even implement the proposal. They might buy the stocks and bonds, but you actually have to sign off that you've made all the decisions, and they're just giving you advice. That's the way it works with Yoatzim, with investment advisors. You also have marketers, investment marketers, and investment marketers generally will work for specific investment products or some of the investment houses where they are marketing the services, right? They could be marketing a specific fund, right? Or they might be marketing other like investment services that are offered by the company. Okay, but they're not actually doing the management. The management is when you want to have your money managed by a financial professional here in Israel, so you need to work through a menahel tik. Okay, the menalei tikim are generally not the custodian of your assets. With the large investment houses, they also have menalei tikim, and they also are custodians of your assets. But with the banks, so you can have a menahel tik, an outside menahel tik who manages your money that is held at the bank. And in Israel, menalei tikim charge a percentage of the value of the portfolio on an annual basis for managing your money. Okay. If you work directly with the banks or the investment houses and you don't have anybody managing your money, so then you will pay, usually it's an additional 2 other fees that go to the banks. Okay, one is called a Dmei Shmira, or a custodian fee, and the banks will often charge up to 0.5% a year for that. And there's going to be transaction costs for buying and selling. Okay, so you have to understand exactly what you're doing when you go and you work directly with the bank. How is your money going to be invested? You have to understand really, like, are you making the decisions yourself? Are you just consulting with somebody, or are you giving over responsibility to somebody else to manage your account? Right? When you work with a portfolio manager, you're giving over responsibility. We don't call our clients and ask them if they want to buy a specific stock or a bond. What we do with them is we define at the beginning how they want their money to be invested, and then we have a limited trading authorization to be able to manage that money. So generally, the people who want to work with portfolio managers tend to be people who want to outsource that part of the management. It's somebody who might work with a yoetz and at the bank, or will be somebody who wants to get some advice, but they're really comfortable making the decisions themselves. Okay, the banks offer a whole wide range of savings plans and deposits where you can lock up your money, right? You can lock up your money for different periods of time, daily, weekly, monthly, for quarterly, yearly, for many years. You can have savings plans where you're contributing money on an ongoing basis, right? Those types of plans generally will pay a lower rate of return than if you had a traded security, but they're also easy. They're very easy to buy into. They're very easy to do through the bank's website or through your local banker. And so many people will choose to put their money into those savings plans or deposits. Okay, the next level up, I would say, is a bond. Right? A bond is a traded security. I mentioned before, right, that those are like IOUs. And so those are traded on the stock market. So I can go in and buy a government bond. A short-term government bond is called the makam, right? A longer-term government bond, which they might be different types of government bonds. In Israel, we have bonds that not only have fixed rates and variable rates, but we also have bonds that are linked to the inflation rates. Okay, those are all different types of bonds that are available. And then we have stocks. Okay, and we mentioned before also in terms of diversification, you can also invest in different currencies. You can invest part of your money over here in Israel in shekels, and you can have a portfolio outside the country, in your home country, or in countries around the world. Okay, the most popular financial instruments to invest in are mutual funds and ETFs. Okay, a mutual fund, think about it as a big basket where everybody puts your money in the basket, and there is a manager of that basket, and he or she will choose how to invest the money in the basket. Usually what they'll do is they'll publicize what their intentions are, and like they might set up a mutual fund to invest in Israeli technology stocks or in international telecom stocks. It could be any different type of characteristic, and they will define. And then if people like this company or like the specific fund, they'll put money into this basket. They'll buy shares of the mutual fund, and the manager will manage that money and will charge a management fee. Okay, mutual funds are transacted at the end of each business day here in Israel. They're not something that you can buy on the market on a day-to-day basis, on a second-by-second basis. An ETF, which is an exchange-traded fund. So an exchange-traded fund is also similar to a mutual fund. In most circumstances, in most cases, they track indexes, although it doesn't have to be that they track an index. An index is something like the S&P 500, which tracks the performance of the 500 largest industrialized companies in the United States. In Israel, two of the more popular indexes are the Tel Aviv 35 and the Tel Aviv 125 indexes, which are the top 35 capitalized companies in the Israeli market and the top 125. And so the index tracks the performance of all of those companies. And there's a specific formula of exactly how they calculate it based on market capitalization. But an exchange traded fund can actually be bought and sold on a second by second basis during the course of the trading. So it's more like a stock that actually has to be bought and sold on an ongoing basis. Okay, there also are things like hedge funds. A hedge fund, we're not going to go into it. They're in the alternative category, let's call it. A little bit more sophisticated and complicated in terms of how they're managed. Okay, let's take a look a little bit at the performance numbers of the Tel Aviv 125 versus the US indexes, because this is something that we often hear. Why would I invest in Israel? Israel has been underperforming the US, right? The question that we had about the S&P. Why are all the Israeli investment houses now marketing the S&P 500 that their pension funds should track the S&P 500? Because if you look at, this is what's happened over the last 7-8 years in the markets, right? The lower line there is the Tel Aviv 125. The middle line is the S&P, and then the NASDAQ, right, technology index. Okay, that's what the performance has been. So if I look at this, it seems like a no-brainer, right? Why should I invest here in Israel, even if the Israeli shekel has been appreciating against the dollar now for many years? But even if it's appreciating, why would I invest locally? So this is to give you a little bit more broad perspective. So instead of just looking at it at the last 7 years, this looks at it over the last 24 plus years. Okay, and here we see what the Tel Aviv 125 index did over that period of time, which was a 430+% rate of return versus the S&P's 309. So the thing I want you to take out of these two graphs is not that, oh, we should all invest in the Tel Aviv market. Oh, the Tel Aviv market is for sure. Baruch said that the Tel Aviv market is for sure going to outperform the S&P. Look at it, did this over. No. If I was a Navi, I would know where the markets are going. I don't know where they're going to go. Okay, we don't know. It's part of proper diversification to recognize that we want to have our money invested in different places. And there are good reasons why we want to have, and we should have some of our money invested locally. But statistics and graphs can be manipulated, and they can be manipulated by marketers as well, trying to pick the exact period of time where their investment performed or outperformed other investments. So you have to be very, very careful when you're looking at things. And just because the S&P has outperformed, the Tel Aviv market over the last 6 or 7 years does not mean they're going to do that going forward. Okay. This shows a little bit about how the Tel Aviv stock market is priced today versus other indexes, right? So here, again, we're not going to go into too much detail, but something that's very basic that people talk about all the time when investing is something called a PE ratio, which is a price to earnings ratio. Means that if a stock is trading at 100 and it's earning $10 a year, so its PE ratio will be 10, because you'll be earning back the value of the stock in 10 years of earnings. So one of the ways that we look at to see how valuable or how expensive, better yet, a market is we try to see what the PE ratios are. So you see that in this example, you have the all world PE index, which is that purple one at the top. You have the green one in the middle, which is developed markets, excluding the US. And then you have the PE ratio, PE numbers for the Israeli market. You look back at the big technology bust at the beginning of the 2000s, you'll see how high they were there in the mid 20s. And then even when it crashed in the market again in 2007, 2008, they weren't even so high. They were only at 15, but they went down very, very low during that period of time. And then they've been growing, growing, growing. And actually, I don't know if I have the other graph, but the current P ratio right now of the S&P is approximately 28, if I'm not mistaken. So it's actually even higher than those three graphs here. So I don't know where the S&P is going to go, but I do know that it's very expensive right now, and you have to be very cautious in terms of going in. Okay, we talked a little bit about the different asset classes. So this is a chart, right? It's not up to date in the last number of years, but it was produced by the Bank of Israel that looked at these four major asset classes over 30-year period of time from 88 to 2017. And it looked at the Tel Aviv 125 index versus the housing market here in Israel versus a general government bond index, and the S&P 500 in shekel terms. And so you can see that the rate of return over that period, a long period of time, the average rate of return for the Israeli stock market, the Tel Aviv 125, was about 8%. Right, that's the top line, and then the lines just below that, the S&P and the housing market was probably it's closer to 7% at that point in time. Now they've caught up in the last 7 years, so it's probably they're all very, very similar. But anytime somebody comes to you and says to you, definitely we should all be investing in housing because the Israeli real estate market, does way better than the stock market, so show them this chart and remind them that over long periods of time, averages revert to the mean. And oftentimes it'll be very difficult to get that outperformance. And all those three asset classes have done very similar. Okay, let's talk a little bit about investing in Israel versus abroad and some of the advantages and disadvantages. So when you're investing locally, obviously, right, there's proximity. You can go into your bank, you can have easy access to your money. I know lots of clients over the years who have had problems getting their money out of their home country because they're not there. I've even had clients who have had to fly back to their country of origin in order to access the money that they had saved there because rules changed and they couldn't authorize transfers. So there's a certain advantage in terms of investing locally. Now, that doesn't mean that you have to put all your money in the local stock exchange. You can have a portfolio at your bank or at a local brokerage house, and you can have assets all over the world. But it means that having it local, and there's a certain ease of use, being local, the knowledge of the language, again, for people who are coming with the language. So, you have the local market, you have the local language that hopefully you'll all become fluent in if you're not up till this point in time. Okay. Abroad, it's more difficult to do that, which is why the majority of money around the world is actually invested locally. Americans have the majority of their money in the US. Canadians have their money invested in Canada. Germans have their money invested in Germany and in the German exchanges. And same thing with Israelis. And there's a good reason why, beyond the fact that you can open up the account close by, but there's also good reasons why you want to be in the local market or why people are in the local market, right? The local market is going to be very much connected with what's happening economically. So it's going to be tied to the inflation rate. The bonds that are bought and sold on the local market might be indexed to your inflation rate, or will definitely be tied to what the local interest rate is, right? What's happening locally, if all of a sudden there's high inflation, so you'll be able to be protected by being in the local market, right? If your currency is very, very strong and is appreciating, so being in the local market will mean that it will keep your value over the long run. And that's why investors invest the majority of their money in their local market. That doesn't mean you have to do all of it. It just means that there's a good reason why that actually happens. Okay, now in terms of taxation, right? In Israel, there is no inheritance tax here. in the US, if as an Israeli, not I'm talking about as a non-American, if you invested in the United States as an Israeli, you would actually pay inheritance tax on money invested there. It's over $70,000, over $65,000. You would actually have to start pay this. Your estate would have to pay inheritance tax. Okay, there are other benefits in terms of the taxation here in Israel, like residential rental income can be exempt up to a certain amount. It's like a 6,000 shekels a month of residential rental income. If you have multiple properties, there are 3 different methods of taxation, but the easiest one is the 10% of the total revenue. Okay, if it's commercial rental, so then it's taxed at your marginal tax rate. Okay, in the U.S., it'll be abroad. Let's call it. It'll depend on which country and what type of asset you're investing in. Generally, Israelis do not use a lot of leverage. They don't finance their investments in the markets. Here, they will finance real estate, right, through mortgages. In the United States or in other Western countries, I would say that the use of credit margin is much more common to invest on margin, like leveraging your investment. There's a lot more bureaucracy here in a lot of ways, right? Obviously, investing abroad depends on the country. And as I mentioned, in terms of the currency risk, there's a big negative in terms of investing your money outside the country in other currencies, because we don't know what's going to happen in the long run to the shekel dollar rate. Now, it could go up. It could be beneficial for you in the long run, but it might not be. And so by investing in the local currency, you eliminate part of the risk. You eliminate that currency risk, and which is another reason also to be investing locally. Okay, let's talk a little bit, mention a few things about tax planning or the tax system and how it works. Okay, if you're American, right, you should understand about the FBAR, the Foreign Bank Account Report, right? If you have more than $10,000 abroad in foreign bank accounts, you will be required to file an FBAR in the United States. So you have to be aware of that. If you would set up an Israeli account, you have an obligation, and it's very highly punitive if you do not file. Okay, another concept that you should understand was called a PFIC, which is a passive foreign investment corporation. And again, this is for Americans. Americans investing outside of the United States have a problem investing in a passive foreign structure. So a mutual fund, for instance, is a passive foreign structure because it's a company structure where you are passively investing. You're not picking the individual stock. You're not, you're just going into a passive structure. And so PFICs in the United States are taxed in a prohibitive manner. They're taxed at your marginal tax rate. And that can be very high. And you will have extra reporting requirements, and there'll be a deemed sale at the end of every year. So there's a lot of disadvantages for holding PFICs, for holding mutual funds or ETFs. And so Americans who need to construct a portfolio here in Israel will need to do that by buying individual stocks and bonds. And that's what we do when we manage portfolios for Americans here in Israel. You have to be aware of the dual taxation if you're American. If you're a non-American, if you're a Canadian or British, South African, so most of the time, as soon as you leave your country of residence, you do not have to pay taxes there anymore. The United States is one of the 2 countries in the world that require all citizens around the world, American citizens, to continue to file taxes in the United States and to pay taxes there. And so you have to be careful when you're investing in general that you're not going to be taxed twice. You might be taxed twice in the sense of let's say if the tax rate in the US was 10% and the tax rate in Israel is 25%, so you might have to pay the first 10% to the US and the other extra 15 to the Israeli government, right, in order to get to your 25% own. But you don't want to be in a situation where you're paying different types of tax to the different countries, because that could end up actually being real dual taxation. I'll give you an example. Once had a client who was investing in oil wells in the United States, and that type of income in the United States was defined as being, let's call it just X. It was royalty income, or however it was being defined over there. And so they were paying taxes in the United States as tax on X income. But in Israel, they didn't have that designation of income at all, because there aren't a lot of oil wells that people are investing in. And so in Israel, they were being defined as being a capital gain. And all of a sudden, we had a situation where the income in two countries was being taxed in different ways. And then there was a possibility of having both of those taxes being due. So you have to be very careful to make sure that the same type of income is being taxed, and it's also being taxed in the same year. Because if you have investments that are being taxed in different years, you can also run into this problem of dual taxation. Okay, for Olim coming to Israel, you get a 10-year tax holiday on any foreign sourced income. That means that if you have investments abroad, if you have earned income abroad, that means that you are earning the income when you are abroad. Not that you're working for your employer over here, or your employer like in foreign country, but you're working over here. But you are actually abroad when you're earning that income, or the money is abroad when you are earning it. So you do not have to report or pay taxes in Israel for the first 10 years. Okay, it's a major advantage, especially for non-Americans. Because if you're a Canadian, for instance, in theory, what you could do is you could become a non-resident in Canada, take your money out of Canada and bring it to another country. Don't yet bring it into Israel, and you could actually have a 10-year tax holiday where your investment income will not be taxed anywhere, because it's not going to be taxed in your home country, in Canada, in this example, because you're no longer a resident there. It's also not going to be taxed in Israel because you haven't brought it here to Israel. So you might be able to find yourself in a situation where you can avoid taxes for 10 years. In Israel, there is no universal reporting requirement. That means that all regular income in Israel is taxed at source. What does that mean? That means your employer is taking off taxes for you. You fill out a form at the beginning of the year, which gives them all the details they need to calculate your tax rate, assuming that this is your only income. And if you're investing money, so that whoever you're investing money with, they also have a legal obligation to take off taxes for you, and they do that automatically. So you do not have to file a tax return here in Israel. Now, you might want to under certain circumstances, especially if you think that somebody withheld more taxes than they should have, or if you've changed jobs. There could be a whole wide range. If your legal situation has changed, if you had a child over the course of the year, there might be lots of reasons why you might want to file a tax return, but you don't have to, unlike many countries. Even if you're earning a large salary, right? Maybe not that large. If it goes over a certain amount, then you do have to file a tax return. But if you might be earning a very nice salary and not have any contact whatsoever with the Mas Haknasa, the Israeli tax authority. Okay, let's take a question break. Ariel.
Sure. Okay. There's a question about someone who may be going back and forth and switching jobs between Israel and America. What should he do regarding pension, ishtalmut, and the like?
Consult a financial or accounting professional, because it's too difficult to answer that kind of a question without understanding the specific circumstance.
Okay. Does an apartment of my grandma consider it as an investment for the future?
An apartment of their grandmother?
Possibly of the grandma. I don't know if the grandmother's alive or not, but apartments in general are considered an investment, like we spoke about.
Yeah, if you're not living in that apartment, and even if you're living in the apartment and you own an apartment, it's your home. It's also an investment. I don't generally look at it at your personal home where you're living in as being, your number one investment. Yes, it's there and it's can be part of your financial plan, but considering that you need to have a place to live, that's not going to be, your first thing, your first asset that you're going to be buying, selling, and structuring as part of your portfolio. It's more considered like your home.
There's a question about Tel Aviv stock exchange, or I guess Tel Aviv 125. Does it include only Israeli shares, Israeli companies? So the answer is yes. Some of the companies are dual companies, but yes.
That means that dual means that they're traded on two different exchanges. So you might have them traded on the Tel Aviv market and one of the foreign markets. But yes, all of the 125 companies are local Israeli-based companies that are traded locally.
Okay. Someone is asking, what does it mean to leverage investments?
It means that you're borrowing money in order to invest. So a bank might give you money to increase the amount that you can invest. Let's say you have $100,000 and the bank says, okay, well, if you really want to invest more than that, I'll actually give you a loan of 50,000. Of course, they'll charge you money on that. They'll charge you interest, so they're making money. And then you can buy $150,000 worth of investments. But you got to be very careful, because when you leverage, you might actually lose money. And if your value of your portfolio goes down, then they can call the loan back at any point in time, and you can find yourself in very, very big financial problems.
Someone is asking if she, as a U.S. citizen, she invests in the U.S., does she need to pay additional taxes in Israel?
Depends on if they're in their 10 years or beyond the 10 years. If they're within the 10 years, they won't owe anything more to Israel. Beyond the 10 years, they will have a reporting requirement, and then under most circumstances will owe additional taxes here in Israel.
Someone is asking about Russia. Is there a double taxation in Russia for Russian citizens? I don't think so. It's only the US, Philippines, and Eritrea. As a non-resident in Canada, my apartment that I rent to someone will be taxed or will not be taxed?
As a non-resident in Canada, you will have your income taxed as a non-resident, so there will be withholding tax in Canada.
On rental income.
On rental income, I believe, as well. Yeah, again, you'd have to, if it was a financial asset, so it would be held at source, the taxes. I don't know how it would work with a rental property. But it's a good question for your Canadian account.
Someone is asking if an American is required to file taxes with the IRS when their only income is in Israel and already taxed.
Can you repeat that
If
again?
someone does he need to file in the US for his Israeli income that was taxed in Israel?
For what type of income?
Doesn't say, but I assume regular income.
So as an American, you have to file taxes in the United States. You don't have to file taxes here in Israel if you're working here locally. Taxes are taken off at source for you, but in the US, you would have to file.
File, but not end up paying taxes usually.
Not necessarily paying taxes, because you might have paid more taxes. You might have paid a higher tax rate here in Israel, and therefore you get a credit on the taxes that you paid here in Israel.
Okay. That's it for now.
Okay, great. Okay, so let's go on. Okay, so successful investing. So we talked about a bunch of these things already, right? One is just the taxation, right? Something that's called rebalancing. You have to remember, whenever you start off investing, you might have a certain strategy, right? You might say, I want to be 50-50 in stocks and bonds, 50% in stocks and 50% in bonds. but things will always change over time. Things go up and down in value. So what happens if you start off at 50-50, but the stocks make a lot of money and now they went up by 100%? Well, the bonds, let's say the bonds stayed exactly the same. So then all of a sudden now my portfolio is completely different than what it was previously. It now might look like, a portfolio of 65 or 70% in stocks and only 30% in bonds. So you might have to like rebalance over time. That's something that's always an excellent exercise to look at your portfolio at least once a year so that you can rebalance. Whenever you go into any investment, you have to understand how you're going to exit that investment. Okay, that doesn't mean you have to know exactly when you're going to sell, but it means you have to have a strategy. Okay, if you're in a financial asset, so it might be easy from a technical perspective to sell your portfolio at any point in time, but you have to know, well, how am I going to wind down this? When am I going to start reducing risk? When am I going to start selling? You can't wait till the day before. Right? I'll tell you a quick story. I know somebody client who came to us a couple of years after the great financial collapse in 2008, 2009, and his company had been successfully acquired by a very large financial institution. He was continuing to work, and he had his pension with that financial institution, and all of his salary was there, and he was doing fine. He had a very large amount of money that was promised him because they were bought out. And 2 months before his retirement, the financial crisis happened and the company went bankrupt. Okay, lost everything. So you have to understand, right? Like, again, maybe in his circumstance, he might not have had so much flexibility, but you have to just understand you can't necessarily wait to the last second and then all of a sudden try to exit at the optimal level, at the highest point. You have to already like put a plan in place that is going to look at how you get out of your investment, because ultimately we want to use our money for spending, right? You have to think about liquidity, right? Nizilut, right? Stock market investments are generally considered to be very liquid, right? That they have active markets and you can buy and sell at any point in time, but not every security has liquidity, right? If you go and you buy the S&P 500 and you look at one of those indexes, so they have tremendous amount of liquidity. If you look at one of the big, 7 companies, you can sell your stocks and shares in a millisecond, but there might be lots of stocks or securities that have much lower level of liquidity, and you have to take that into account when you're investing. Okay, and contrary investing basically just means not trying to follow the pack. When everybody's talking about an investment, when everybody's saying that this is the next hot thing and you should be doing something, oftentimes it means that you should just have to think twice about whether that's really the correct direction. Okay, I want to talk a little bit about investment fraud. Why am I talking about investment fraud when I'm just trying to teach you initially, as an intro? Because we have had too many clients over the years come into our office having lost money because they didn't know the basics of how to evaluate investments. Okay, so we're going to go through a bunch of these here very quickly. I'm not going to have a chance to go through all of them, but I think it's important just so that people understand. You can't judge a book by its cover. You have to do your due diligence. You have to really look into it, especially if it's a non-publicly traded investment. It means if you go to the bank and you're buying a share of Teva or an Israeli stock, so then you can check it out very easily. You can look online. You can see exactly what you're buying. It's a publicly traded security that's regulated by the Israel Securities Authority. But if you invest in something where you're handing over your money to somebody else, so it's not regulated necessarily, and you can't judge people by just the fact that you got a recommendation from somebody in your shul or a family member or something else, or they look reliable, or they sounded great, right? You can't do that. You have to really look into it. And if it's something that you don't understand, so then run away from it. You have to understand what you're putting your money in, and you have to understand the level of risk. You have to understand how you're going to access your money, the liquidity there. Anytime you get people telling you that you have a guarantee of gains, or that it's incredibly low risk but with a very, very high potential gain, so run the other way. Risk is associated with gains, meaning that yes, you can make a lot of money in certain types of investments, but those investments by nature are more risky. You just don't necessarily understand where the risk is coming from. Okay, but if you are guaranteed, there's a very well-known investment fraud that took place here in Israel about 20 years ago, in the Angle world, English-speaking world here in Israel, where they were promising in a real estate investment, 16% rates of return guaranteed, right? No risk involved. They were going to do amazing. And I had people who said to me, why should I invest with you? And take risk. I can get 16% with no risk at all. And it ended up being fraud, and they ended up losing all of their money. Okay, anytime somebody is coming in with secrets or inside information, trying to make it like an exclusive club, right? Oftentimes, all that is a sales pitch. Okay, if you have a very, very sophisticated investment that's being marketed to the general public, so be very, very wary. Right? If it was so amazing, if it was so profitable, and they would be going after big money. They wouldn't be going after small investors and trying to take $10,000, $20,000, $30,000 from people, right? They would be going after big money from institutions who are much easier to go to if it's an amazing investment. So if there's something that somebody's presenting to you and it sounds too good to be true, so oftentimes it is too good to be true. Okay. Offshore, I talked a little bit about that with the Canadian example in terms of bringing your money outside of Canada before it comes into Israel. So an offshore financial center or an offshore country is a country that does not charge non-resident tax. That means you can invest in that country as a non-resident. I can take my money to Switzerland or the Bahamas or the Virgin Islands or any number of other states around the world, and I can invest my money there, and they will not charge me tax as a non-resident. Used to be, going back decades, that the offshore world was an incredibly profitable, well-known way for people to hold their money. But the transparency in the financial world has gone up tremendously in the last decade or two. And it's not as easy to hide money, and you have to be very careful with where you're sending your money, because again, you're dependent on the regulatory environment. You're dependent on being able to access that money. That could be the greatest investment in the world, but if you can't access that money because somebody is going to, either because the Israeli government won't accept the money from an offshore center because they're worried about fraud or about taxes or not being reported, right? You have to be very careful about investing your money in all of these third-party countries, third world, or not even just third world countries, because they're very sophisticated first world, let's call it, financial centers that also do this, but it's become much more difficult to access your money over there. Okay, be very skeptical of marketers, right? That are not disclosing where they're being compensated from. Okay, you have to know exactly where somebody is being incentivized, and understand that everybody has incentives. Everyone. You just have to understand where they are being incentivized. It's very, very important. Okay, how they react to your questions, your due diligence, very important clue. But don't just think that it's if they are excessively warm. It could be exactly the opposite. Excessively warm, excessively cold, sales tactics. Those are meant to bring emotions into the process and to help you avoid really thinking rationally as you're making your investment decisions. Okay, be very careful when you're giving your money to a third party. Meaning if you are not holding on to that money directly through your custodian, through your bank or your investment house, you have to do double the due diligence to make sure that your money is going to be safely invested. Okay, you always have to understand when you're investing, can you lose money with this investment? If somebody tells you you cannot lose money, run away. You can always lose money. Trust me. Heard many, many, many stories. Okay, you have to understand how realistic the expected return is. Right? What are all the assumptions? What are all the scenarios that could happen? You have to understand, as I mentioned, the exit strategy. How am I going to get my money out? Do I need to depend on some other sucker coming in and buying from me in order for me to get out my money? Or is it going to be returned at X, Y, and Z point in time? And you have to use your common sense, right? You have to understand, is this a good business idea? Does this make sense, right? You have to understand the taxation of it. Understand the people who are involved and do your due diligence. We've got a lot of ability to do that due diligence online now. The internet gives us that ability. Take it seriously. Look into people and see who you can really trust with your money. Okay, we talked a lot about this, understanding the risk profile, the competency, understanding how you can lose your money. Okay, let's talk a little bit just about, because it was also a question that was mentioned before. What are the pros and cons of doing it yourself versus hiring a manager? Okay, some of the pros of doing it yourself. Obviously, you're going to gain a lot of knowledge, expertise. You're going to learn more. You're going to be able to keep down the costs. You're not going to be paying management fees. Although you also have to be careful. In the example I gave earlier about the banks. So if you work with the banks or if you have your account at the bank, you have to make sure that the custodian and transaction fees that the banks charge are not higher than what you'd be paying for an investment manager. Because oftentimes the investment manager can bring down those costs for you. So you have to make sure that you're comparing apples and apples. But oftentimes when you're doing it yourself, you can keep the costs down. Okay, obviously you're lowering the risk of fraud. If you are investing it yourself, so then you know what's going on and hopefully you're confident enough to be able to invest and not lose your own money. If you feel that you can outperform the market, focus your investment better to what your goals are, that might be another reason why you might do it yourself. Although you got to be very careful with this as well, because you have to realize the market, the big market, right, is a marketplace where you are competing against everyone else out there. And that includes tens of thousands, if not hundreds of thousands of professional investors who are also investing and trading and buying. And so when you're on the one side of the sale, you're buying or selling something, somebody else is on the other side of the sale. And so always, like feeling like you can outperform the market, right, can sometimes be a little bit illusory. Okay, and then another reason to do it yourself might be it's fun. I know a lot of people who like trading. The excitement's involved. It's like gambling in a certain sense, right? The ups and downs, etc. It's exciting, something to do. And again, it's fun and it can be fun. You just got to be careful and do it in a way that you're investing what you can also afford to lose. Okay, some of the cons, right? As I mentioned, right? Most investors underperform the market. That has been shown statistically. In fact, even most professional managers underperform indexes over time. So you just have to be very careful. Okay, you need to have time. You have to have time, right? and it can also, experience, right? Both of those things are invaluable in terms of your trading. And if you're starting off, you might think you understand the market, but you might not have gone through the different types of markets, right, that other professionals have gone through for decades. There's a lot of stress involved, right? Or you might just have no interest in doing it yourself. Those all might be reasons why you wouldn't want to do it by yourself. Versus hiring a manager, right? When you hire somebody, you're outsourcing it to a professional. Many times people will actually pick multiple professionals to manage their money. That's a different type of diversification, right? We talked about diversifying into different asset classes. You can also diversify into different professionals, right? So you don't have all of your money just with one person. Right? Hiring a manager will save you a lot of time, right? If you're hiring them, obviously you're paying them in order to save you the work and time involved. In general, it has been shown that professional managers do have better performance in the long term than individual investors. And from my experience, that's largely because we can prevent investors from making bad mistakes. Right? When Corona hit in 2020 and the market crashed worldwide within 30 to 60 days by anywhere from 30 to 50%. So thank God we were able to prevent any of our investors from selling at that point in time. And there were a lot of people who panicked and they sold. And by the end of the year, especially in the United States, the markets were well above what they started at the beginning of the year. So you got to prevent yourself from making mistakes, and sometimes having a manager being able to advise you allows you to make better decisions. And obviously, you're reducing your own stress by outsourcing it to somebody else. Right? What are some of the cons? Not every manager outperforms the market, as I mentioned, especially like the general indexes. There can be the risk of investment fraud, as we've mentioned. You can be paying a lot of money to managers, and you have to be aware of how much you're paying to make sure that they're not eating too much of your profit up. You have to understand how to choose a manager, like we talked about. Who are the people? What's their level of professionalism, licensing, etc. And you have to also understand their fee structure. And many times you don't have that complete transparency involved when you are hiring a manager. But in any event, no matter which way you look at it, as I quote below, you can delegate authority, but you can't delegate responsibility. It doesn't matter if somebody's managing your money. It's ultimately your responsibility to look over, to evaluate, to ask questions, and to make changes if you're not happy. Very, very important in the long run. Okay, we have about another few minutes left. Why don't we take a few more questions? Actually, before we go on to, we talked a lot about these already, the dollar cost averaging abroad versus in Israel, understanding how you lose money. So this is a book that I wrote a number of years ago called The Financial Guide to Aliyah and Life in Israel. It deals with more than just investing. It has a chapter on investing as well, but it deals with all of the different financial topics that you're going to be covering in this course. A number of years ago, we put it on online. You can see the address there at thefinancialguidetoaliyah.com. So you can go online at any point in time, and all the information is there, and it can help supplement all the things that you're learning in this course. And here I'll just put up if anybody wants to sign up for our newsletter and stay in touch. We generally will send out a newsletter once a month with an article that I've written usually, and some other articles and general news that are valuable to hear about in the financial world here in Israel. Okay, Ariel, what other questions do we have to wrap up?
Okay, I just put a link for the financial guide to Aliyah online. Okay. A question over here. Because of the 10-year tax holiday, would it be good to transfer currency to USD to invest in the USA instead of Israel? Are there better options? Uh,
Um,
Complicated question, depends on the source of the funds.
yeah, so technically, um, you have to have the source of your income really has to be in US dollars outside of the country from when you made Aliyah, right? Or it has to be earned outside of the country during that 10-year period of time. In theory, if let's say you made Aliyah and you had all of your money was here in Israel in shekels, and you said, "Oh, I'm going to convert it all to dollars and move it abroad." I'm not actually sure. I don't think that that's legal. I think that they would actually look to tax you. It might be something that you could technically do, um, but I don't think that technically it's allowed.
Uh, yeah, someone's asking over here about employee shares, taxation on employee shares that he got as part of his job. How does he pay taxes on
Uh, uh, yeah, beyond the scope
it?
of this
Yeah,
class.
okay. Is it illegal to keep money in offshore?
No, it's not illegal, but countries around the world have become much more careful um, and discerning in terms of making sure that the money that you're bringing to them has been declared and that you're paying tax on it. So yes, you can hold your money in one of these offshore countries, but you still might have a tax obligation. And so um, you will have to go through several extra steps to get the money into the country, and you also have to prove that it has been taxed and reported properly, if it was necessary to.
Someone is asking about Karen Kaspit. Um,
What about
what,
it?
like, is it a good idea? Well, it would be a problem for Americans.
Yeah, because it's structured. You want to talk a little bit about that, Ariel?
Sure. So current Kaspi is equivalent to what's known as a money market fund in the US. It's a short-term, it's a mutual fund that invests in short-term bank deposits and low-risk bonds, which gives you full liquidity. You can sell at any point of time, and it gives you pretty much the current interest rates of the market at the time. So right now that interest rates are high, you can get somewhere between 4 and 4.5% from a current Kaspit. It is a good idea for short-term investment. It also has some tax advantages because it's taxed, it's inflation adjusted, even though it's 25% taxes. But with our current high inflation and with such low return, it is an advantage. But for an Americans, it could be a problem of PFIC, as we mentioned. So you should probably stay away from that. And instead, you could probably invest in short-term government bonds. Do you do financial planning with young Olim?
Yes, we do.
Okay. Can I ask why your site is not on the co.il domain?
Um, you can ask. I don't remember why we set it up as com instead of co.io. I don't remember at this point in time. Many years
Okay.
ago.
Someone is asking for a recording of this session. You missed the beginning.
Yeah, I think it'll be posted, I believe, on the WhatsApp group information about that, and you can contact Nefesh B'Nefesh about it.
Okay, someone is asking about if they have two different Karen Hishtalmuts.
Can they have two different Ishtamoots, or
Well, the question is, what if you have two different Karen Hishtalmuts? So I'm
you
not
can
sure if they
have
mean.
multiple? Yeah, you can have multiple different Karen Ishtamoots. You can have different Karen Ishtamoots from your different employers. In fact, some people will actually open up a new Karen Ishtamut every 6 years, because they want the time to start ticking. Because again, every 6 years, you have access to the money. So let's say, I'll give you just like a simple example. Let's say you contribute for 6 years in Keren Ishtalmut number 1, and you know that you're going to use that money in a year or two, but you also know that you want to be able to access a second sum of money in 12 years, right? So what you would do is you would open up a second Keren Ishtalmut in year 7 and start contributing there. Maybe even go back and contribute to the first one and do that. And then maybe you would take out your money in year 7 or 8. And then you've already started that other Keren Ishtalmut in year 7. So it'll be now available for you in year 12, the end of year 12. So there might be certain circumstances where you might want to or might, but yes, there's no problem with having multiple Keren Ishtalmuts.
Of course, the limit of the tax benefit is up to the amount overall.
Correct.
Someone's asking about the book link on our website is not working for some reason. You could just leave a message in the contact form over there and we will contact you. Can you recommend a high yield savings option for an emergency savings in Israel? So if you're not an American, you can do a Keren Kaspit. That's a good option. If you are American, you should probably put it in a short-term government bond, which is called Makam. You can do that through your bank or through a brokerage account in Israel. As an American Oleh who married an Israeli, can my wife take advantage of the 10-year tax holiday?
Nope.
Okay, that's it.
Okay. Thank you. I hope this was informative for everyone. And if anyone has additional questions, please feel free to be in touch with us and to sign up for the newsletter. And I hope I get to meet some of you in the future, maybe on this side of the ocean. These kind of sessions are difficult because we don't get to see anyone or we don't interact with anyone. So it'd be a pleasure to reach out if anybody has any other questions. Okay, be well, everyone. Good luck investing. Be smart. Bye-bye.